Decentralized finance, and what do you need to know? Overall, the blockchain-powered space of decentralized finance is still nascent but offers a compelling value proposition whereby individuals and institutions make use of broader access to financial applications without the need for a trusted intermediary. Especially people previously without access to such financial services could benefit from this development. Even more so, DeFi promises a full-fledged capital market. And at this point in time, the potential is limitless. Some pointers here. DeFi favors network effects. The true innovation is created by uniquely combining the applications. Secondly, while it may be difficult to determine which blockchain protocols and applications will get the most usage long term, currently the advanced decentralization, programmatic flexibility, and the truly enthusiastic developer base gives Ethereum the lead. For Ethereum, going forward, the fate of adoption of DeFi is tied to the scalability and usability of Ethereum. DeFi has yet to prove its true improvement. Currently, the usability is unintuitive, risk-adjusted pricing is non-existent, and the liquidity cannot compete with the centralized alternatives. Nevertheless, we are bullish that these are issues to be dealt with in the ecosystem. What's the buzz about DeFi? DeFi has become a trending topic in the blockchain community. In contrast to the decentralization of money through Bitcoin, DeFi aims for a broader approach of generally decentralizing the traditional financial industry. The core of the initiative is to open traditional finance services to everyone, in providing a permissionless financial service ecosystem based on blockchain infrastructure. Broadly speaking, DeFi is an ambitious attempt to decentralize core traditional financial use cases like trading, lending, investment, wealth management, payment, and insurance on the blockchain. DeFi is based on decentralized applications, dApps, or protocols. By running these dApps on a blockchain, it provides a peer-to-peer financial network. Like Lego building blocks, every dApp can be combined with each other. Smart contracts work as connectors comparable with perfectly specified APIs in traditional systems. The rise of DeFi. While the initiative to open finance is generally blockchain agnostic, it flourishes on more flexible blockchains, i.e. programmable smart contracts, as well as with a healthy developer base. Today, nearly all DeFi projects are being built on Ethereum, making it the standard default blockchain for many dApps. Taking a look at the average data of November, Ethereum dominates existing blockchains in amount of application activity, user activity, and also in volume traded and locked, with limitations. The large transaction volume on EOS is a phenomenon throughout the year and is often considered as a benefit of zero transaction cost, thus possibly inflating transactions. Regardless, it indicates that zero transaction costs are an attractive goal to support DeFi development on the blockchain. In a nutshell, other competitors for the DeFi are currently far away as they either lack a healthy developer base, IOST, or true decentralization and thus core benefits of the blockchain, EOS. Some simply lack both. This raises the general question whether DeFi can also be replicated on the most famous blockchain protocol. Contrary to popular belief, dApps are indeed possible on Bitcoin, but programming them is much more complex. By design, Bitcoin emphasizes security, something that is very important in financial infrastructure. Henceforth, Bitcoin might be suited for a robust, notably smaller DeFi system. Bitcoin's most successful DeFi application is so far the Lightning Network. The second layer of protocol has been developed over the past few years and is based on a technology called state channels. The Lightning Network allows for ultra-fast and cheap payments and has seen impressive growth in 2019 with already more than 6,000 active users and $6.2 million locked in the network. Other notable Bitcoin dApps are in decentralized exchanges like BISC or Spark Swap. While it may be difficult to determine which protocols and applications will get the most usage long term. Currently, the advanced decentralization, programmatic flexibility, and the enthusiastic developer base gives Ethereum the lead. As a result, Ethereum-based dApps will be the focus of this report, and the DeFi projects now account for a substantial share of Ethereum's sprawling ecosystem, particularly with respect to Ether ETH locked-in smart contracts, which is often used as a measure for growth in the DeFi sector. The amount of Ether locked is collectively worth over $680 million, roughly 2.5 million Ether, in terms of volume locked. Maker DAO dominates across the major applications, with Synthetics, Compound, Instep, Uniswap following behind. However, over the past few months, Maker DAO dominance started to drop, and other platforms have been collecting volumes. Increasingly, the DeFi tech stack has more integrated as dApp combines layer 2 services with each other. It's very important to note that the fuel keeping DeFi running is Ether and DAI. The Ethereum native Ether is needed to pay for blockchain transaction fees. It is also the easiest cryptocurrency to convert into other currencies. DAI is a layer 2 creation on the Ethereum blockchain and offers the benefit of a stablecoin, being fully decentralized, synthetically pegged to the US dollar, and thus inherently less volatile. A major driver behind this success has been the ability to circulate DAI between different DeFi protocols and to use it as a unit of account on these dApps. What are now the core benefits of DeFi? DeFi is built on a top line of blockchain. Often, the blockchain is referred to as a general infrastructure layer. Consequently, DeFi can be viewed as a cluster of second-layer applications. This allows DeFi to inherit the core property of decentralization. It is important to note that this only holds if the blockchain itself is decentralized. Fulfilling this precondition, the core benefits of opening finance are shared with the core benefits of blockchain, which are truly decentralization allows censorship resistance, worldwide participation regardless of social status, and dispenses trusted third parties. Secondly, utilizing blockchain as technological infrastructure, which allows relatively speedy and low-cost transactions and the immutability of the financial contracts and contract automation. Thirdly, DeFi applications, which allows that the user remains in possession of the private keys. This is referred to as non-custodial in the blockchain ecosystem. The user is in full control of the money without a trusted third party. Increased ecosystem transparency and thus price and market efficiency. Minimal principal agent risk, as asymmetric information are non-existent and the personal interests are governed by a transparent protocol. And lastly, DeFi favors network effects, as lots of innovation is generated by uniquely combining different projects in layer 2 or even layer 3 application. As an example, one of the largest active DeFi contracts locks $10 million without a bank account, without a third party, and the customer is always in possession of the underlying cryptocurrency. Put this in contrast to the traditional financial industry, where enormous resources are allocated for a system of trust creation, which comes at the cost of heavy centralization. Example, the too big to fail banks. Transparency, example, the 2007 crisis, and censorship/discrimination in many countries. Furthermore, the system fails to keep us up with pace in the digital age. A cross-border transaction on average takes 3 working days and costs 7% fees. Then why has not DeFi adoption skyrocketed? Nevertheless, the adoption of DeFi currently lags behind the promising theory. For a broad adoption of decentralized applications, DeFi has to overcome major obstacles, which include the DeFi ecosystem is a field of technical experiments and innovation. Accessibility is global, but yet unintuitive in terms of UX. Furthermore, as it is based on cryptocurrencies, converting traditional currencies into crypto has to be done as a pre-requirement. The liquidity is outpaced by centralized alternatives. This is important as liquidity is pivotal for efficient pricing in the financial industry. In fact, most protocols are currently unable to compete as efficient low-fee competitors. In the light of double-digit stability fees, MakerDAO is currently not used as a permissionless credit provider, but rather serves as a decentral way to create leverage in Ethereum. By converting Ether to DAI and reinvesting this into Ether, this follows the centralized strategy of leverage long positions. Products are over-collateralized. As there is currently no credit scoring or shared collateral, many products must be over-collateralized, sometimes as high as 150%, which reduces the leverage for professional traders or the opportunity to obtain access to capital that the user does not own. Traditional credit scoring based on identity or sophisticated deleveraging systems, liquidation algorithms, and insurance funds allows a high capital efficiency in centralized systems. This could be an avenue of research. The technical risks, such as bugs in smart contracts or blockchain layer, are tough to detect because of the novelty of these approaches. By design, false or fraudulent transactions are irreversible on the blockchain. Further, there are operational risks due to the failure and manipulation of price feeds, so-called oracles, and complex governance protocols. And lastly, DeFi poses a potentially systematic risk arising from the interdependencies of DeFi protocols. This can be observed at Maker DAO's too big to fail status, arguably the most critical piece of infrastructure within DeFi's given space, reliance on oracles and stablecoins. Some of the following issues on Ethereum itself could potentially create issues for DeFi. Network congestion. In times of high usage, Ethereum has had a few clogging issues on its blockchain. If the network gets congested, a transaction can remain in a pending state, which ultimately results in market inefficiency and information delays. Transaction costs, such as on-chain gas fees, as transactions are competing based on gas fees. Transactions with lower gas fees may be left pending at lower priorities. And lastly, timing issues at the state of the blockchain is updated on average every 15 seconds. This is very uncommon for traditional finance, and DeFi interest and prices are calculated per block, and for robust operation, it requires stable block mining. Even if these issues are related to Ethereum specifically, similar issues can exist on any blockchain. Specifically, Ethereum sometimes faces these network performance issues owing to its popularity and usage. On the contrary, most of the other existing blockchains do not currently face scalability issues simply because they do not have enough traffic or are much more centralized by design, allowing for higher speeds and better performance. Yet we believe that most of the raised issues are explained by the nascency of the open finance industry, and these applications remain in an experimental stage and are expected to mature, solving many of the current and key issues. Let's take a look at the future. While the stack of decentralized finance apps has become broader, the projects have struggled to gain traction beyond the users already familiar with blockchain and Ethereum. Thus, the growth in 2019 can be mainly explained by blockchain enthusiasts. Given the above-mentioned roadblocks, in particular the accessibility and thin liquidity, DeFi is currently a space of innovative experimentation instead of professional financial operations. Nevertheless, this can be said for the majority of the crypto ecosystem. And to fill the gap between theory and practice, DeFi is yet to overcome its core roadblocks. Low liquidity, unintuitive UX, and accessibility, capital inefficiency, hidden risk, and regulation have somewhat stifled adoption owing to its nascency. These issues might be mitigated as the industry matures. Promising solutions are already on the way, making 2020 an exciting year to follow.